Hello, everyone. I am so happy you're here. Thank you so much for being with us this afternoon. My name's Jamie Seward. I'm the Associate Director of Affinity Engagement Programs with the Office of Alumni Relations. Now, before we proceed, I'd like to acknowledge our co-sponsor, the Real Estate Affinity, and our partner, GL Capital. Now, before I turn the program over to our guest speaker, I encourage you to ask questions by typing them in the Zoom Q&A in the bottom of your screen. We also have the chat open, but we don't want to lose your questions in the chat. So please place your questions in the Zoom Q&A. Now, I have the pleasure of introducing our special guest, Andrew Hinton. Andrew Hinton manages operations, development, and sales for GL Capital. He supervises construction and renovations for their existing portfolio and new acquisitions. He also oversees property management functions, including leasing, maintenance, and tenant communications. Finally, as if he doesn't do enough, he leads efforts for disposition of his existing assets, as well as he runs his own residential sales business with Keller Williams. Prior, Andrew earned a Master of Art in Design at Maryland Institute College of Art and an MBA at Johns Hopkins Carey Business School. He specialized in marketing during his business school career. He also worked as a mentor for out-of-school youth in North Philly. Andrew also worked to develop affordable technologies for developing communities around the world. One enterprise commercialized greenhouse technologies in rural Kenya and South Africa. He's pretty amazing, and we're very, very lucky to have him here today. So without further ado, I will turn the program over to our wonderful speaker, Andrew Hinton. Andrew?
Thank you, Jamie. I really appreciate the kind words, and of course, have so much appreciation for you and all the work you do with the Real Estate Affinity Group. Thank you, everyone, for joining me today. I am thrilled to be able to discuss the topic I am the most passionate about in the whole world. It's real estate investment, and specifically, it's the steps to source, analyze, and acquire investment property. I definitely encourage you now, in the middle, in the end of the presentation, at any point, to ask questions or share comments. I like to start off by just getting to know a little bit better the people who are in the audience. So if you could just jot down in the chat box the location where you're calling in from today, as well as your experience level and number of units you've bought. If you own your own house, you can say 1 unit. If you own an investment property in your house, you could say 2. I just like to get a feel for how much people listening in have actually invested before in the past. Excellent. So Philly, Washington, D.C., Baltimore, Seattle, Washington. So a few people between 0 and 1 units. Excellent. I think you'll get a lot out of the presentation today. And for those of you who have more than one, I think you'll also learn a thing or two. I'd love to know. So keep participating there if you haven't yet. So before I dive in, I just want to let everyone know that the information has been organized by me personally and reflects my company, GL Capital's position about real estate investment. Is not directly representing the Johns Hopkins University. It doesn't constitute a full and complete review of investment information or substitute for your own due diligence. If you're considering making a real estate investment, there are certainly risks associated, and certain real estate offerings may require accreditation. So today, what we're going to be discussing, why real estate investment in the first place. Sometimes the most important thing is developing a big why, and we'll get into that. I'll talk a little bit about GL Capital, my business, the acquisitions process in general, and then we'll go into a little bit more detail about sourcing, analyzing, and then acquiring the properties. At the end, I'm happy to answer your questions, and then if we have time, I can run through one of the acquisitions my company has gone through as a second case study. We'll see how much time we have left for that. So why real estate investment? This is the most common reason why I'm seeing online that people want to invest in real estate money. It's to make a little more money so you can go travel a little bit more. And this is usually the thing that gets people interested in the first the very first time. But I think you have to look a little bit deeper at yourself, at your personal values, and really what you want to get out of this new income and this new wealth that you're building. So in addition to that tropical vacation, I want you to consider, what is your life's purpose, and how can real estate investment and the passive income you earn give you back some of your time, maybe an earlier retirement, or maybe a chance to take some leave from your work in order to go out and do the things you want to do, climbing mountains, maybe giving back in some way through your community service or charitable contributions. Gives you a chance to spend a little more time with your family, your friends. These are the reasons why I invest in real estate. So the passive income I earn can be spent towards the areas I want. If I were to go to a tropical island, I think in some way or another, I'd probably be finding a way to get more work done, and really just explore my passion even more for real estate investment. So let's start from the very beginning. A long time ago, people who bought investment property got wealthy. How did they get wealthy? How do you build wealth through real estate investment? Maybe some of you can go ahead and in the chat box and let me know. I'm thinking of three things in particular that you can earn money from in some way through real estate investment. Through equity, appreciation. So tax-wise benefits, that's definitely a benefit. I think of that more ancillary. There's three main ways that I'm thinking of. So cash flow, I saw appreciation. And the third one, people tend to miss, but it's probably the single best way and least risky way you can earn money through real estate investment. These are all right answers, by the way. So it's been said numerous times, rental cash flow, right? The amount of rent you can receive minus all the things that cost money. So your operating expenses, your insurance, your repairs and maintenance fees, taxes. Second, the appreciation. The markets tend to go up in value over time. And I saw some of you talking about adding value or increasing the equity. I think of appreciation as something that you can wait for, but also you can force in some way. And we'll talk about that a little bit later. The last way, and in my opinion, the most risk-free way, let me just double check to see if anyone said it so far. Debt pay down. So the beautiful thing about real estate is you can leverage it. You can take a loan out and be able to buy more real estate with less of your own money. But every month, as you collect rent and you pay down your mortgage, you're actually paying yourself back. So the tenants that you rent to are building your own equity in the property. This is a foolproof way that you can earn money through real estate, and you can capture that debt pay down when you sell the building at the end of the day. The reason I like real estate is because it's really solid returns. I have a lot of interest in being able to get the most returns, as most people do in their investment portfolio. And people don't often think of housing and real estate as that. But if you look historically, housing has been right on par with the stock market. We pump so much money into our 401ks, and we spend so much effort thinking about how the stock economy is doing, when the housing economy has done just as well over time. But more so than the equities market, you see that real estate is more stable. While the peaks aren't quite as high compared to the equities market, the rock bottom of the markets are not nearly as low. You can see this green line, which is much more stable, flatter, if you will, than the equities market. If you're heading toward retirement or you're really planning for your family, that stability can be really, really, really important. And part of the reason that investors prefer real estate, or at least want to diversify in some way into the real estate. So those are a few reasons why real estate investment is so beneficial, right? It's a way you can make money passively, so you can go out and do the things you want to do and accomplish your real purpose in life, which may be outside of what your career or day-to-day job is. And it offers really solid returns and also really good stability. My company, GL Capital, formed about 4 years ago. We specialize in real estate investment, development, and we also do property management for multifamily residential. Multifamily, which is apartments, we focus on, including student housing, mixed use, and some retail. Our investment base comes from all over the world, and we're very proud that we can support Baltimore, where everyone's investing in, through money that's coming from elsewhere. And all of our projects and really our whole operating structure is built around getting really good returns, but also improving the communities where we are operating. Since forming in 2016, we started with a couple houses. For those of you who have 1 or 2 units, you can see that in only a few years, you can build your portfolio quite large. And it's through this sourcing, analyzing, and acquiring properties that we're going to be talking about today. Why multifamily specifically? Well, for me, it's a very resilient vertical within the real estate, the different real estate assets. So if you look at COVID-19, which is arguably the worst time that you could possibly own real estate, the multifamily sector did fine. It was very resilient even in April and May. You can see from one year to the next, from 2019 to 2020, there's only about a 2 or 3% decrease in the amount of rent collected. And this is only by the 6th of the month. So by the end of the month, we can see those numbers are even closer together. GL Capital, very engaged. We have our own speaker series called CRE Investment Talks. We also sponsor a summit once a year. It's called the CRE Connect Summit. So I encourage you to follow us along if you are interested in learning more about different topics related to commercial real estate. We also have a strong sense of community. We love volunteering for different Johns Hopkins events. And if you're interested in real estate, then we'd love to get to know you a little bit better. All right. So thank you for someone who did ask a question. I see. How do you measure returns in real estate? We'll get to that during the presentation. If anybody over the course of the presentation does have a question, you can feel free to ask in the chat group or the Q&A. So here's the acquisitions process that I think of when I think of acquisitions. These are the critical moments in the course of finding property and acquiring it. First, you have to find the property. We'll talk a little bit about how I've sourced deals in the past and how other investors are sourcing deals. There's underwriting, which is the financial analysis where you're looking at a piece of property for what you can earn as a return on investment. And then the due diligence process. And this is where you are trying to find out all the information and uncover all of the risks that might be associated with a certain property. Is it built well? Is there going to be a lot of expenditures you have to make? Is it a good market? Is the owner telling the truth in the things that he said while you were doing your initial underwriting? You're doing a lot of due diligence even before you put in a contract. You make an offer to buy real estate. After that initial due diligence period, you are where you're going to see the property for the first time. Then you'll have the contract negotiations. You give an offer. Usually there's a back and forth between the owner and you. I would recommend if it's one of your first properties, having a broker or some real estate agent who's supporting you in doing those negotiations. And then you'll create a contract, sign the contract. You move on to the next stage of due diligence. I've broken it up here because the due diligence, the second phase, you're going to hire an inspector. And I'll go through all these details. I'm giving you the broad overview now, just so you have a prompt for when we get there later on. The second due diligence, you'll hire the inspector. You'll do your financing. You'll do your title review. Again, you're going a little bit deeper even than the first due diligence in trying to find out whatever you can about the property. And then finally, your settlement. Now, the way we do it, we have a group, partners, and this is something I see when people are wanting to get involved in real estate, that they're going to have certain partners because you can pool more money together and potentially go out and buy more. Now, when you're working with a partner, there's two very critical points that I've highlighted here. we call it investment committee. For you, it might just be a really heart to heart with your spouse or heart to heart with your investment partner about, hey, is this something we want to go ahead with? And I would encourage that before you make the contract and before you actually go to settlement. And we'll get a little bit more into exactly what this all means, but this is the overview. Whoever asked the question about the measuring returns, we'll get into that when we talk about underwriting. All right. So the very first step, what are you investing in? What is the property you want to buy? For some of you, it's going to be a house. For some of you, it might be a multi-unit, a smaller multi-unit. Maybe it's an office building. Maybe it's a shopping center, right? Before you start looking, you need to really decide, what are the parameters? What are the things I would like to include in my criteria? It's very important you have specific criteria, because if you just go out and say, I want to buy any property, you're going to have thousands of options, and it's not going to be easy for you to decipher what's a good deal or what's not. However, when you have very specific criteria and you start going through the process of reviewing a little bit more, you'll start to understand where the good deal can be found, at what price, and that's when you're going to have success in trying to do your get the good deal. So first parameter you're going to want to decide is the location. What city is it located? What neighborhood is it located? Is it going to be a Charles Village type property? Is it going to be the Baltimore County area, DC, Philadelphia? I know one of you is coming from Seattle, maybe a Seattle neighborhood that you know really well and you think you can drive to if something should happen that you need to get to. So obviously your first step is think about what location. What type? Is it a single house? Is it a 2-unit duplex? Does it have retail on the first floor and apartments upstairs? Is it a luxury market? Is it a low-income housing market? And then economic terms. What's the price range? Is it 100,000, 200,000, 10 million, 20 million, right? There's all the different ranges. And when you're going out to find property, it's very important you have a specific price range. The property condition. So some people who maybe have a background in some type of handiwork, they like the project, right? They go in there and they have to renovate and they have to improve it in some way. And other people, they don't want to have to do anything. They want to buy the property, get the keys, hand the keys over to the property manager and just forget about it. So again, think about what works best for you. I'll talk a little bit about how we are handling our parameters, but for everyone, it's going to be a little bit different. What kind of construction materials? So we invest a lot in Baltimore City. So a lot of our buildings are very old. Some people are more interested in a newer construction where it's got PVC piping instead of galvanized, metallic piping. It's really up to you. What features it has. So for those of you looking at single family, is it a 1-bedroom, 2-bedroom, or 3-bedroom house? For those of you looking at multifamily apartment buildings, does it have a pool? Is it a certain square footage? So these are a little bit more tactical than bigger picture. And then finally, amenities. Does it have cable Wi-Fi included? Is there a sprinkler system? Here's an example of one of the investors I work with. He's looking for things that are between $100,000 and $150,000. He's looking for a 10% discount to market value. He's looking for anything in Baltimore City near Patterson Park, and he wants to be able to earn 10% cash flow and something that's in good condition. He doesn't want to have to go in and do a lot of effort. This is just an example I wanted to give you so you could see that there's very specific criteria that's necessary. And since he's given me this grade, we found 3 deals in the past 2 years. So this person has come to me, basically given me a set of specific criteria. And sure enough, because it was so specific, we were able to find 3 really excellent projects that he was able to close on in the last couple of years. Just to clarify, that 10% discount to market value and that 10% cash flow, we're going to get into exactly how to calculate that later on. So if that's something you're interested in. So you have your criteria, right? First step, very important, figure out what your specific criteria is. After that, you're going to start to go out and identify projects that fit those criteria. Now, don't expect there's going to be thousands of properties. If you've done your parameters, criteria correctly, in fact, there may be zero. You might have to wait a little bit of time, or maybe there's only one or two, and you're going to have to compete with other investors for it. The key is that you are expanding as big of a web as you can. I like to think of it like a spider web. The bigger the web, the more chances that something's going to stick somewhere. And here's the ways that you can start to get the word out that you're looking for a specific investment property. The MLS is what we as real estate agents use. It's basically a database of all the properties that are listed. So if you have a realtor or if there's a commercial real estate agent that you know, it'd be good to talk to them first and foremost because they'll have the best access to the different databases that are available. You could also go direct to owner. If you know somebody who's thinking about selling a house or someone who's investing in real estate, maybe they want to sell the property and you don't necessarily have to use something that's on the market. Some of our best deals have come from off market where we researched who this building belonged to and we somehow found his phone number and we gave him a call and it took like 6 months, but finally we were able to close on this property that was sitting right next to another property we owned. And it was just going out and finding that owner. You could go to an auction. Be a little bit careful at the auction. Know your limit because they're designed right to get people to keep bidding and bidding and bidding. Other agents. This is something that specifically for commercial property, you're going to want to go talk to as many commercial agents as possible. For residential, it's like a single family house. There's almost all the listings are on the MLS. So you can use an agent that you know and trust for that. Wholesalers, these are similar to agents. They're more for, if you think about people who have a property that wouldn't necessarily do well on the MLS or on the main listing. So usually it's a distressed asset in some way. Maybe, it's got, terrible mold problem. Like it's something you wouldn't necessarily want to put on the MLS, but there's wholesalers out there who are able to find these properties undervalued and market them to investors. Driving for dollars. So this is similar to direct to owner. This is how we found the deal nearby, the one we closed on, which had really grown grass. It had the windows were boarded up. We knew that this was not a property that was doing well for whoever owned it. And that's when we decided, hey, let's find out who this owner is and try to get in touch with them. That's what driving for dollars is. Using your own database. So this, again, how are you getting in touch with people that might know about that investment property? Again, you're trying to cast the largest web you possibly can. Anybody have other ways that they find property besides those that I listed here? If you think about it, put it in the chat. And then lastly, you have your criteria and you have your list of properties. And now you're going through and you're saying, does this fit my criteria? Sometimes, especially when you're talking about what you want your return on investment to be, or does it make financial sense to buy this property? You have to do a little bit of calculation. But for some of the other parameters, is this the right size, the right number of bedrooms, the right property condition, right? You want to make sure it fits all those parameters. And then, so if it fits some of those basic parameters, then you're going to start to do analysis. Now, I structured the analysis in two different levels. One is back of envelope, where if you have an envelope on your desk or a Post-it note or a notebook or whatever, you can figure out approximately what the return on investment is. Very, very, very high level. And that to me is something you're doing every time you see a deal because you just want to get into the practice of doing the very simple analysis. If it accomplishes your goal, then you go into a more deep analysis where you're going to want an Excel. We'll talk about both the back of envelope and the basic, the more detailed analysis. And then the basic market research goes along where you're going on, trying to figure out the rent rates that might be suitable for that particular area. So the back of envelope. So I was thinking last night, it was about 8:20 p.m. when I was putting this presentation together. I was like, where would people want to invest if they're coming onto this JHU talk? So I chose within 1 mile radius of Hopkins, Johns Hopkins University. So I painted this circle and I put everything that's between 150K and 250K. I thought that was a good range for that market where you actually might find something, and it has the potential to be undervalued. So there's 15 or so, 10 or so properties that fit the description between $150,000 and $250,000 within 1 mile from Hopkins. And I started looking at the prices, looking at the number of bedrooms. And I found one property, 3647 Chestnut Ave. It's a 3-bedroom and it's on the market for $214,000. So right off the bat, I thought, there might be something here. So that's when I started my back of envelope analysis. First step was, and this is very simple to do if you have a Zillow or if you have a realtor who you're working with, you can let them know, hey, what are the rent comps or comparables or the properties that are similar to this? What are they getting for rent? And so in this general area, in the last 6 months, there's been 7 closed leases. And their average rates are they actually range from $1,500 to $2,750. Let's knock off $2,750 because that's probably a little bit of an outlier. It's probably a stunning, very large house. So if you're looking between $1,500 and $2,000, you're probably in the $1,700-$1,800 range. If you wanted to go a little bit deeper, you'd look at the pictures of the house you're thinking of and then the comparable houses and try to match up if it's been renovated recently or has not been renovated recently. Then with the target rent, let's call it $1,800, you can use the 1% rule. So the 1% rule is basically the highest level of analysis. If the rent is equal to 1% of the purchase price, then you can consider it a good deal. It's a rule of thumb. I don't necessarily advise you to do it, but on a very, very high level, that's what some investors are using. In this case, it would have to be $180,000. Now, is it possible to win the deal at $180,000 if it's worth $214,000? Sure, I've seen people get discounts that much. Is it likely? No, people probably aren't gonna do it. Does that mean you should just say, no, this deal doesn't work, it doesn't pass the 1% rule? Not at all. In fact, if you were gonna go this route, I would almost consider you do the 0.8% rule. If it's 0.8% of the purchase price, then it's probably worth considering in a little bit more analysis. So what I do back of envelope, again, it's just a few more calculations. And I've tried to make it as straightforward as possible. If you have questions on any of this, you feel free to let me know in the chat. So first, it's the total acquisition cost. So what's your ballpark purchase price? And then add 10% as a closing cost fee. So in this case, I'm offering $180,000 and I'm adding 10% to that, which I must have switched from 170 to 180 because my 17,000 here is off. So sorry for that typo, but let's assume that your total acquisition cost is about $198,000. Then you want to project your annual income. In this case, it's 12 times. I use 2,000 here. I was probably a little bit too aggressive and maybe hoping that the cap rate would be slightly higher. But let's say 2,000 because there are comps for 2,000. Then your annual income is about 24,000. So your ballpark acquisition cost, which is your offer price plus about 10%. Then your projected income, which is 12 times the amount you think you can get for rent. Keep in mind it's a 3-bedroom. So some of the 2-bedroom comps were a little bit lower and the 3-bedroom comps were a little bit higher. So maybe that's the reason I chose 2,000. Anyway, 2,000 times 12, 24,000. Then you can assume a 50% expense ratio. Again, this is back of envelope. This is just the starting point. So we're going to go a little bit more in depth later on. Finally, calculate your NOI, which is your projected income, 2,000 times 12, divided by 2. 2,000 times 12 is 24,000. Divided by 2 is 12,000. And finally, you're going to divide your NOI, 12,000, by your acquisition costs, 198,000. In this case, I did 197,000. And that gets you your cap rate. Now, the cap rate is used to compare things without having to deal with what are your financing costs, what's your mortgage rate, how much of a loan are you going to get. 6% is strong. It's, again, the amount of return you're going to get depends on how much risk there is. And remember, this one is right next to Hopkins. So there is a little bit of stability in this neighborhood. So you're going to get a slightly lower cap rate compared to what you might get in Northwest Baltimore or a part of town that doesn't have as much stability. So 6% is solid. I think in this case, I would want to go and do a deeper level of analysis. So I know there are some calculations in here. At this time, I'm going to move on to what I would do as a next step when I start to look at a more detailed financial pro forma. Is there anybody who has a question on what we did so far? I'm seeing that there is a couple questions on measuring returns. We're going to get into that in the next couple slides. Sorry, I haven't answered yet. And then will you share a copy of the slides? Yes, I can do that. I will touch base with Jamie and get the slides to her. Any other questions on the back of envelope? I don't think we'll use envelope. We'll have to change it to back of napkin or something because people aren't using envelopes so much anymore. All right. So let's transition from back of envelope where someone sends you an email and says, hey, you might like this deal. And whatever you have, you're writing down, 50% expense ratio. What's the rent I can get? Oh, it's a 5% cap rate, 06, 07, 08. That's in my range of what I'm looking for. Let's move on and open up the Excel and start to plug in some of the more detailed components of this. So what you're looking at is a pro forma here. I'm sure a lot of you are using it in your job, so I don't need to go into detail on exactly what this is, how it's used. But if you look line by line, you're going to start with your rent, and then you're going to take about 5% of that and and remove that as a vacancy factor. Now, you're not going to get vacancy every year, but over the average across the industry, for most people, every few years, you're going to have at least a couple months of vacancies. That's what the 5% is taking off. It's very, very rare that 365 days a year, every single year you own a property, that it's going to be full. If it is, you're doing a great job managing it. Or maybe there's someone who's living there that just really loves the property. It's not impossible, but generally at some point, you're going to have people move out, go in there, paint it again, clean it up, repair some things if needed, and then put it on the market again and then rent it out. Then you'll pay your operating expenses. So in here, I simplified it a little bit for everyone's sake. There's some things in here you might want to add in terms of if you're a very detailed person, but this will get you most of the way. And it's real estate taxes, licenses, like the Baltimore City registration fees, and service contracts. So this might be pest control. If you have an exterminator coming, might be a cleaner who comes once every couple months. You'll pay your insurance every year, your property management fees. This is to the person who's going to respond to the maintenance things. This is probably your best place to save money if you're just buying one house, even though it's going to be hard at first. If you do it yourself, again, that's more cash flow that's coming to the property. But if you're hands off and you say, Andrew, I want you to do it, or you find your own property manager in Seattle, Washington, it's going to cost you, I said, in this case, about $1,500 a year for a house. Repairs and maintenance, again, this is tuning the HVAC system, maybe some roof repair work, maybe you have to replace a microwave or something like that. That's the repairs and maintenance fees. I put an expense ratio here of about 37%. That's pretty realistic, I think, according to what we've done in the past. You want to estimate, obviously, more conservatively, so on the high end, so 35, 40, 45, 50% is a good ratio to use. Then you have your bank payment. So every month you're going to pay the bank, and it's a combination of principal and interest, and unavoidable unless you're paying with cash. But we've included that here in the pro forma, and you're going to get your net income. So that's the total income you're earning minus your operating expenses, in this case 8,300, minus your principal and interest payment, in this case 9,300. And then so $5,000 a year is your net income. Again, this is a hypothetical, but I'm thinking that's pretty solid if I can get $400 a month on a rental property. Then we want to calculate, okay, if that's how much I'm earning, how much is that as a percent? Because remember, you have opportunity costs. You could be putting in the stock market. If you can make 7.5% in the stock market, why would you only make 2% in the real estate market? That's why you need to calculate how much money you've put in and try to get that return on investment. So in this case, if you bought it for 180,000 and you have your closing costs, I use 7% in this case. 10% was probably a little bit too high. It's useful if you're doing mental math, but in this case, 7%. Then your renovation costs. So I looked at the pictures and they weren't really in great shape. So I think actually the more I looked into it, 180,000 as a starting price might actually be a good price because it's been on the market for a few weeks now. And maybe the owner is thinking that he just wants to get rid of it. He or she wants to get rid of it. So 180,000 is starting price, but I'm going to go in there with 25,000 to replace the floors, to paint the whole walls, maybe new cabinetry or countertops, and a new HVAC system. So everything's working pretty well and it looks new. And I estimate about 25,000 to do all of that work. So that gives you your total cost, in this case, 217,000 minus the loan you got from the bank of 144,000, and you have your total cash equity that's required to buy the building. So that will get you your net income and then your total cash paid out of pocket. Divide the two and you get your ROI on a yearly basis. But that's only 1 year, and you're usually not buying and selling in the same year, right? So you have to look at the lifespan of the project. So then we take that first year, we add however long you're going to own the property. In some cases, it's maybe 5 years. Some cases, maybe it's 30 years. That's up to you. But I really encourage you to go in there and think about how long do I want to own this? And then the very end, you're selling. So most of your income is actually going to come from that sale year. So I've done that for everybody here, where we look at 2021, 22 through 2025. And in my opinion, I'm thinking 2026 is when I'll sell. Now, going back to the reasons you make money through real estate, it's rental cash flow, it's market appreciation, and it's paying down your debt. In 5 or 6 years, you're going to get a chance to pay down some debt. You're going to get a chance to get some market appreciation. If you hold it a 6th year, maybe you get a little more appreciation and you pay down a little bit more debt. So I don't encourage you to choose 5 years, but it's also been hard to fit it on the page. And so 5 years felt good for this example. As you can see, the income starts at $2,000 per month and goes up 3% every year. The expenses also go up 3% every year. Inflation, we accounted for here. I think the other reason I chose 2,000
Hi, everyone. I see that we have lost our speaker momentarily, but just bear with us and we'll try and get him back. So just give him a second. I'm sure he'll log back in. So just bear with us. Thank you for your patience.
Hello, Jamie, can you hear me? Sorry about that.
That's okay. That's okay. I think we still have everyone here. And
Uh,
if you, do you want me to share your slides?
Um, I
Um,
will, if you make me a co-host, I can start sharing again.
okay. Thank you, everyone, for your patience. Technology is great when it works, and we really appreciate y'all hanging in there with us. I know it's such a good presentation. Nobody wants to leave. So we got him back. Hopefully, everyone can see. Thank you again for your patience. I'll let Andrew pick up where we left off.
All right. I think we should be good to go. Sorry about that. I just moved and still figuring out the Wi-Fi things here, but I'm on my hotspot now. All right. So cash on cash, year one, 7%. And you're probably thinking, that's good, but it's not something you're going to write home about. Again, that could be your time to say, I'm done with this deal. Like it doesn't reach my 10% parameter. That's totally okay. No one should ever pressure you to say, okay, this deal, even though it's not what you really wanted, means you should still go ahead. But let's say 7% is acceptable to you. So now we're going to look at kind of the end game, which is when you go to sell it. And in this case, 2026 is the sale year. So we're looking at not only no, this is half. So you're getting half the year's worth in those. Internet was unstable again, so I'm so sorry. So you're getting half the income from January to June. Well, let's say we bought it for 180K, and we got it at a good time because January or February, who wants to buy in February? So we got it for 180, but it's worth 200. Then we put in $25,000. In fact, game, and it forces you to. So is everyone with me? The uh, the discount 144 they paid you, you paid the bank, and the bank principal went down to 124,000. About. I think it was the one thing that nobody really thought of. That's $20,000 in 5
Andrew,
years that you earn.
can you hear me? I'm sorry to interrupt you. It's really laggy and we can no longer see your slides. So
I
if
see
you,
there's a hand raised here. Let me try to see what the question is.
yes, Andrew, just so you know, we can't hear you that well. It's lagging, but I can share the slides if you want me to do so.
I'm back on the other Wi-Fi. I think I'll be okay.
Oh, good. You sound better now. Sorry again, everyone. Thanks
Yeah.
for bearing with us.
Right. You'd think after a year of quarantining that I would have gotten the Wi-Fi figured out. I don't know how far back I should go. Should I start from the beginning of the sale year? Jamie, would that be? Because
I think we stopped at detailed financial analysis, and you're doing a great job. It's an awesome presentation. So,
let me
whatever you're.
zip through the last year. Were you able to get the first year? I think that was before I broke up the first time. So I'll go to the last year, and then we'll talk a little bit about the due diligence process, because I know we're getting pretty close to 4, and that's a big part
Yes,
of this.
and thank you, and thanks everyone for hanging in there. I'll turn it back to you.
All right, so sale year 2026, we chose it as our estimation of the future. We're going to sell in June or July, so I've calculated the January through July rent, January through July expenses, and then I said, okay, 235,000 is a conservative sale value. And the reason that I chose that number is because if you figure, even though we bought it for 180K, it was worth about 200K based on the comparable properties that I saw in the area. We just got it at a discount because it was in bad shape and because it's February and there's not a lot of buyers out there. So I'd encourage you to think about not just what value the property is, but what discount on the market value you can actually get it for. So 235 in part makes up for the discounted price that we got. I mean, 200,000 is the market value. And then I added 25,000, which is the amount of money that we put into the property, the paint, the floor, the HVAC system repair, right? These are all the things that make the property more valuable. And finally, the market appreciation. So 1% a year in Charles Village in the Hamden area for about 10,000 in appreciation. Then the next line here is 124,000. That's the loan balance. So the initial loan we got was 144,000, and we've since paid down 20,000 of principal. It's kind of like the tenant paying you an additional 20,000, but instead of paying you, you pay the bank, and then the bank has a lower principal balance. So if you own your own home, that's obviously something familiar to you. If you don't own your home, this is where you're going to make most of the money in your deal, or at least a significant amount of the money in your deal. That $20,000 of debt pay down. Then you go through your sale costs. You got to pay your realtor, some transfer recordation fees, things like that, and you get your sale proceeds. So the amount of money you earn from January to June 2026, plus the amount of money you earn when you sell the property, that 93,000, is kind of the cookie, the reason you invest in real estate, besides what you can earn every year. So you add up all the money you've earned from 2021 to 2026. I'll say all the money you project. you're going to earn. This is all before you even buy the property. You're doing this analysis. All the money you project you're going to earn, and you divide it by your initial investment amount, which was 73,600. And you'll get an average rate of return of 28%. So again, it's each year added together, including the final year, divided by the total number of years. That's your average rate of return. IRR is another level that we use. It takes into account the time value of money and basically the fact that money today is worth more than money in 6 years. However, for those of you starting out, you can consider the average rate of return and compare it to some of your other investment portfolios that you have or other investments you have in your portfolio. All right, I know that took a few different Wi-Fi iterations to get through, and there may be some questions. If you have anything, you can feel free to let me know. And I'll stay an extra 10, 15 minutes, however long is needed. And we can come back to this for people who have specific questions about the pro forma. I know I wasn't able to clearly share that information. Someone had asked at the very beginning, how do you measure your returns? Well, this is it. How much did you start with cash out of pocket? How much did you earn each year, including the final year? And divide that by the amount of money you started with. That's how you measure your return on investment. And is 73,000 sound like a big number to people? Is that making you think, oh, there's no way I can invest in real estate because I don't have $73,000 in the bank right now? If that's you, then I hope you'll consider what are some other ways that you can either partner with people or more creatively figure out how to get a property with a little bit of a lower cash requirement. So personally, I was investing with people I met at Johns Hopkins, smart, talented, have a little bit of money. Why don't we pool our resources together and invest together? I'm not sure I explained in the beginning, but my two partners we met at the Cary Business School. Do you have friends and family who can invest with you? Or is there some structure where maybe you live in the house and you rent out bedrooms, which is still rental income that you can collect? So if that number is really high for you, I encourage you to reach out to me. Maybe we can talk about some of the strategies that I've shared with people so that they can actually invest without having a huge amount of money to invest. All right, let's talk a little bit about the okay, so the acquisitions process. We talked a little about deal sourcing. We talked a little about underwriting. So you've gotten a deal. Maybe this is the one that fits all your parameters, that 7% a year and 26% average rate of return over 6 years. And you want to go make an offer. Well, first you're going to have seen the property, right? You're going to go walk through it. You're going to go look all the bedrooms, look in the basement, make sure it fits your general parameters. You're going to have your realtor walk through with you and give you some opinions on the value. You're going to do your market research. And then you and your brother or friend or old schoolmate are going to agree and say, okay, let's go ahead. Let's make an offer. You make your offer, the seller agrees, and boom, you're under contract. Now you go into the second stage of due diligence. You haven't bought the house yet. You've only just sourced it, analyzed it, and decided to come up with an agreement with your counterpart on the seller side. Now is the due diligence phase 2. So chances are, if it's your first house, someone's going to be helping you, and that's a real estate agent or some expert in the field. Maybe your attorney is helping in some way with the negotiation if it's a commercial property. I've put this together for people who have never bought a house before. I did see there was a little bit of a mix between people who did and haven't. So I'm going to go through this somewhat quickly so as not to get to some of the things that people might not know who have already. If you're curious about anything I speed through, then feel free to get in touch with me later on, and I'll go through a little bit more slowly with you. But essentially, your first step is figuring out what you want in a property, right? We talked about criteria. And it's going to a bank and saying, is it possible for me to get pre-approved for the house? You've looked at the homes, you've researched their value, and you sign the contract. Once the contract is signed, the due diligence period starts. And there's usually three components of due diligence. One is your inspections. So that's going to the property, looking at all the inspector who you've hired will look at all the different components of the property, the roof, the windows, the doors, the floors, the walls, the HVAC system, the electrical system, every single thing, every single system in the house. And they'll give you a report that says, these are the things that are wrong with it. These are the things that are correct with it. Now, usually at this time, you are able to get out of the contract if you think that there's too much wrong with the property. Hopefully, you're not getting too many surprises, and you can use this as a chance to confirm that this is a good property for you. But in some cases, it is possible that this is the time where you say, I don't want to go forwards. That's why we give you the contingency from the beginning. Second is your finance contingency. That'll say, if I can't get a loan from a bank, then I'm able to walk away. That's a really powerful contingency in the case of something that you might have bought during the COVID situation because banks were being a little bit tighter on their financing. If the bank says you can't go through, well, you don't want to have to buy a house. You don't want to be enforced to buy the house because you don't have the financing lined up. So the financing contingency will get you, through the financing period or give you the ability to walk away. And final is the title search. The title company you're going to hire is going to basically look at all the previous owners and make sure that there's no one that's going to come back to you after you buy the house and say, wait a second, that house belongs to me. That person shouldn't have sold it to you because it's my house. The title attorney is going to be able to go through and make sure that the property is free and clear of any liens, of anything that's going to inhibit your ability to own the property and not have any future legal issues. So again, these are the things that the real estate agent or the representative is going to know inside and out and be able to make referrals for you for, whether it's an investment property or your first house. And even if it's a commercial property, the real estate agents are expert in this whole process. So again, the contract negotiation, engaging your lender and title company, the inspections contingency, the finance contingency, and getting you through to that settlement week. All the things you see on the left side of the screen here. Now, for those of you who may be a little bit more experienced and looking at commercial property, whether it's multifamily, more than 5 units, or a shopping center or an office building, there's going to be some slight differences that I want to make you aware of. First, instead of a typical contract that you're putting in front of the owner that a residential agent will prepare for you, you're going to start with just an LOI where you're going to go back and forth on terms before you put it to a contract. And then a lawyer is going to draft the contract for you. The inspections contingency looks the same, whether it's a residential or commercial property. It's called something different and it's slightly different companies. And you're going to have to get an environmental inspection. Basically, they look at the history of the project to make sure there wasn't a gas station and a bunch of oil underground or some environmental rationale for why the bank isn't going to be able to fund the loan for you. Again, that's usually not required for the residential property, but for commercial it is. If you're using OPM, which is other people's money in order to buy the deal, so maybe a family member or a friend or an old schoolmate, you're going to want to create the investment slideshow. I do not encourage you to do this if you have it's your first time, but if you're looking to scale your business in some way, then certainly having the professional analysis done and delivered to people who are looking to invest with you is going to be important. And finally, you're going to want to, every time you learn something about the property, you're going to want to go back to your financial analysis and update it. Maybe your inspection saw that instead of $25,000, you're going to need $50,000 to improve the area. Well, it's important for you to go back to your deck and make sure, does it make sense with $50,000 instead of $25,000 of repairs and maintenance work you have to do? And finally, when you own the property yourself, you're going to want to create a plan for those first 100 days. The reason 100 days is important is because that's usually the amount of time it takes to start your renovations, get your advertising plan together for the leasing, and do all your property registrations, tax for the city, for any other service contracts that you're going to need to sign. So it's important. Those first 100 days are very important, and something that a real estate agent won't necessarily help you with. Once they close, now a good real estate agent is going to help if you need contacts or vendors or things like that. But typically you're on your own at that point. So it's important that you have planned in advance, because time is money when it comes to real estate investment. And if you're doing it for the first time, it's having a really robust plan is going to help you for sure. So I went through this last 10 minutes faster than I would have liked. However, we got to the end. Jamie, I don't know how. I'm very mindful of people's times. It is 4:00. Thank you for coming.
Oh, well, I think, if you're willing to stay on and
I'm absolutely.
answer people's questions, I'll just answer the one at the end. LOI stands for a letter of intent. You are doing a great job. If you want to answer these questions, I'm happy to stay on, and people who want to drop off, you guys are welcome to go. So please have at it.
All right. Yeah. So really the presentation is over. At this point, you've gone through all of the sourcing work that is required to find the deal that fits your parameters. First, you've created your parameters, then you've sent them out and made your big spider web so you can find something that sticks. You do your initial back of envelope analysis just to make sure it's worth your time to do a more detailed analysis. And finally, you decide that this is a good house for you to make an offer on. You make your offer, you negotiate with the seller. Finally, you come to terms, you sign the contract, and then the due diligence period really starts. You hire your inspector, you go get your financing lined up, you talk to your title agent to make sure that the title's free and clear. And before you close, you really want to have a very rigorous 100-day plan so that you're prepared for what you're going to do once you close. And voila, that's the process. For those of you signing off, thank you so much for being here. There's someone you can talk to about if it's buying or selling houses. That's me. I do have a real estate license with Keller Williams. I help investors every day to look for and close on properties. If it's something about investing in commercial real estate, you can also contact me. I'm doing that through my company, GL Capital. Very, very, very happy to get connected and answer whatever questions you have on a personal nature. And then I'll spend a few more minutes on here if there's other questions. Oh, and then we do have a speaker series called CRE Investment Talks. I did see a few people here in attendance who have participated with us in the past, even have been speakers for us in the past. And it's a great way to just learn about different topics and get involved if you can. So thank you so much for those of you who attended. I'll go through the Q&A now one by one. So where can one find reliable historical appreciation numbers for market subsegments, for particular neighborhoods and property types, not for local market as a whole? So I don't know. Reliable historic appreciation rates. So there are data providers who have some of that information, but my personal philosophy on appreciation is I don't like to underwrite it too much. Or if I do underwrite it, I want to try to be as conservative as possible, because even if there are historical rates, it doesn't necessarily mean that that's going to be the case moving forwards. So while there are certain data providers, I know for residential, there's pay per service type things that I could find for you if that was something you wanted to know about a certain submarket. But I would be very careful about actually underwriting a substantial appreciation rate and using that appreciation as part of your decision to invest. My personal philosophy is make sure the cash flow works with the rental rates that are current, and make sure the sales price is reasonable, even if there is no appreciation. Then if you have appreciation, wonderful. But if you don't, you're not stuck with a property that's worth no more than when you bought it. So someone asked how to get started if you're just starting your career and have no knowledge. I mean, you did the exact right thing, I think, is to is to learn what you can, is to get involved with different real estate events and informational sessions like we're having today. And then, just start by analyzing properties. I walked you through some pretty basic financial models, and the best way to understand the market is just to practice. And if you are in a neighborhood that you want to invest in, or you want to invest in Johns Hopkins area housing, then go look at the list of properties that are on the market in that area and start doing the rental analysis and the expense analysis and the return on investment analysis. And over time, you'll start to get a feel for the market, and your gut will actually be able to guide you towards the right answer, even though you don't have previous knowledge. And then, of course, partnering with people who are experienced, using a real estate agent, using a someone who's been in the business long enough, a mentor of some sort, would be the best way to get started. Tips for finding a good realtor. Interview them. It's a very important financial decision. A lot of buyers of houses or of commercial property know multiple agents. I'd be very happy to help you if it's related to Maryland, or even vetting a realtor in a different market. So sometimes someone locally can ask the right questions and make sure that the person who is representing you, informing you, advising you is the person that they say they are and has a good track record. The amount of deals that they've done is very important, and the success rate of the deals that they've done. And also someone who's investor friendly. So a lot of people are focused on residential real estate. Having someone who works with investors is important because they know the process a little bit better. If you are partnering with others to buy, should you first assemble as an LLC or some type of business partnership, or join as individual co-owners? So like any good lawyer, I would have to say it depends on your situation. I have worked with people who are just buying their first investment properties, and my suggestion was first, you have to have a very serious conversation about who are the roles and responsibilities, and you're definitely going to want to talk to a lawyer and at least get their opinion on setting up an operating agreement. Now, if you actually legally own it as a individual or LLC, there should be a very clear arrangement that shows what happens if, this person does, usually the lawyers are thinking the worst case scenarios and protecting you in case of them. So if you are thinking about investing with someone else, it's worth talking to a lawyer and accountant about the implications legally and financially to go in business with someone else. So that's everything in the Q&A. Now I'll look at the chat to see if there's any more questions. All right. Very, very, very excellent audience. I'm very grateful everyone was hanging on there while we had some technical difficulties. Looks like, does it make sense to purchase a new construction as an investment property? I think it does. If you're the person who doesn't want to deal with any repairs and maintenance issues. Now, the reason I think it makes sense is because you're probably going to get top dollar on the rental side of things. But that's something you have to research first. If buying a new property is going to help you get a little bit more rent, and it's going to give you less headaches because the new property is going to have less issues, repairs and maintenance needs, then in some cases, if you're someone who maybe is going to get a little bit less return, but have a little bit less risk, and you're going to have a less headaches, then that could be a good fit for you. It all comes down to what level of risk you want to take and what level of return you expect for the risk. With a new construction, it's much less risk, and therefore your average return is going to be a little bit lower. So if that is acceptable to you, then yeah, people have done well buying new construction. I see that there are some questions about not really sure here. Can you tell us about the revenue sharing arrangement you have with your investors? I can tell you what's typical. So depending on, it all depends on who, and I'm sorry, Joan, if you had left, I've been really kind of going a roundabout way to answer the questions. It depends. Oh, you're here. So who's doing what? If you answer that question, then you'll start to realize that there's a certain amount of time, energy, and money that's going into the deal. And my suggestion would be make it equitable. So if the investors are putting in 100% of the money, then they should have a higher percentage of the revenue. If someone's putting in all the work, then they should have a slightly higher percentage of the revenue. We source our properties, we do all of the financing, all of the due diligence, all of the management. However, we're only putting up somewhere between 3 to 5% of the amount of money when we close the property. And we're taking 20% of the deal, and our investors are taking 80%. So that gives you a little bit of an idea how our arrangement is. But for folks starting out, it's probably going to be more of like a friend plus you, or a family member plus you going in together. And in that case, if you're doing the same amount of work and you're putting in the same amount of money, then it would be a 50-50 arrangement. If there's some lopsidedness in the amount of work or the amount of money being put in, then you should make it commensurate with that. Be careful going into business with friends and family, colleagues, but don't necessarily make that the reason you don't do it. I think that as long as you have this tough conversations and you have the legal protections, it could be a very enjoyable experience to go into business with friends and family. Maybe advice that other people aren't telling you. Certainly, make sure you have the conversations ahead of time. But yeah, that's the revenue sharing arrangement we have with our investors. See another one come through the Q&A. How do you measure risk, or what is acceptable amounts of risk? It's very difficult to measure risk. That cap rate exercise we went through with the back of envelope, to me, that is a measure of risk, right? The higher the cap rate, the more risk there is. That seems a little bit backwards, but that's the truth. And maybe that's not a good explanation for why there's risk, but it is a good measure of risk. For example, if you're looking in the DC market right next to Capitol Hill and you do that analysis, you might get a cap rate of 4%. If you do the same analysis in West Baltimore, a few blocks west of, let's say, Howard, you might get a cap rate of 12%. The reason being because there's more risk in that West Baltimore community where the renter base maybe is a little bit less reliable and the financing is a little bit less reliable, and therefore the values are a little bit depreciated. So what is the acceptable amount of risk? It all depends on you. Are you someone who's looking for a slightly higher return and having to do a little bit more risk, a little bit more work, or being in an area that's a little bit less reliable in terms of the renter base's ability to pay? Or are you someone that wants to buy a new construction property and never have to deal with the thing in one of the hottest markets? Because that cap rate is going to indicate what level of risk there is. That's how I measure it, and how a lot of people in the business are measuring it. How often do you pay out returns to investors? So we're paying quarterly, and then when we exit, we'll do kind of the lump sum, sale payment. So we structure it kind of like an investment fund. So if you've invested 100,000 and there's a 10% projected annual return, well, that's the same as projecting the 2.5% dividend every quarter. And then we write up a report. We let everybody know what the property expenses were and what the property income was, if there was any major capital improvements that we had to make, what the status is with delinquency and things like that. So, but that's a little bit higher of scale than what folks who are just starting out might be looking at. But that's something to decide if you're working with a partner for the first time. Deciding when to take money out is something that you should consider in the beginning, for sure. Because it could get when there's worst case scenario, you make a lot of money, you're going to want to know how to split it up in the beginning. All right. Hey everyone, thank you so much for joining today. It sounds like we went way over, but appreciate the questions and your participation. And if there's anything else, please
it's
feel
okay
free to
that we
reach
went
out.
over. You're amazing. We really appreciate your time. I will follow up this wonderful, amazing, engaging, informative presentation with an email and the recording and the slides and Andrew's contact information. So look for that in your inbox. We really want to thank Andrew for his time and talent, and of course you for joining today's webinar. We hope that you'll join us at a future program. So with that, I hope you all stay healthy and happy and safe.
Thanks so much, Jamie.
Bye, friends.